gentlemen, welcome. So before we start, Vasu, what is dominating your mind when it comes to 2024? What are you most worried about?
If I had to use just two words, inflation, recession. So
both keep you up at night?
I think, there will be some degree of interplay between them. Inflation is the number one worry for central banks. But the way the central banks tackle inflation, it may result in a recession, which will cause potentially some problems. But then once we go past inflation and recession, then things will start looking a lot better.
All right, thank you, Vasu. Tepuk tangan dong untuk Pak Vasu ya. Nah, kalau ke Prof. Iwan nih. Prof, kalau sebagai bengawan ekonomi begitu ya, well respected, mendunia begitu, tinggal di Istaka tadi ya, cerita-cerita ya. Ini berjarak tidak sih dengan kondisi politik Indonesia saat ini, kondisi nasional?
Ini bahasa Indonesia ya?
Bahasa Indonesia,
okay.
Bahasa Indonesia.
Ya. Saya setuju dengan tadi pernyataan bahwa ada dua tantangan, yaitu R, recession dengan inflasi. Tapi yang mungkin lebih penting untuk dipikirkan terutama oleh dunia usaha adalah bagaimana reaksi dari dunia usaha, bagaimana reaksi dari masyarakat, dan bagaimana reaksi dari pembuat kebijakan, termasuk nanti pemerintah yang baru. Jadi yang
pemerintahnya baru dok? Prof, yakin baru
Oh.
atau berlanjut keberlanjutan? Bentuk lain dari keberlanjutan?
Maksud saya pemerintah baru adalah hasil dari pemilu. Saya tidak tahu hasilnya seperti apa, tapi poin saya adalah mudah-mudahan ada pemikiran baru, karena apa yang terjadi di dunia sekarang itu unprecedented. Jadi banyak sekali, semua orang bicara mengenai uncertainty, tapi ini different kind of uncertainty. Jadi itu saja reaksi saya.
So when you talk with your peers, other professors in Cornell, do they talk about Indonesia and what's going on now?
Yeah, they do.
They do a lot, or just a little bit, and they worry about recession more?
A little bit. If you look at the helicopter view, basically Asia in general, including Indonesia, is doing relatively well compared to the other parts of the world. So this is what sometimes, depending on whom I'm speaking, because I was in the Middle East last month, depending on whom are you speaking, if you're in Africa, you're in Middle East, maybe things are really bad, but when you're in Asia, depending on whom you're talking to, many people complain, but I try to remind them, look at the helicopter view. We are doing relatively well compared to the other parts of the world.
Okay, very well. Prof. Iwan, terima kasih. Tepuk tangan dulu ya. Ini baru awal-awal aja semangat. Nah, Vasu, I will give the floor to you to start your presentation. You have 15 to 20 minutes.
Okay. Thank you very much. And let me just stand over there.
Yeah, sure.
All right, thank you. First of all, thank you everyone for taking the time to be here this evening. And thank you, my colleagues in Indonesia, for giving me the chance to speak here as well. So I'm going to share about the global economic investment outlook. Let me just move forward. Okay. Let's just start by looking at how the markets have done so far this year. And if I had to break down the markets, essentially I'll break it down into two periods. Between January and July of this year, the markets did very well. Because when I say the markets, we're talking about the investment markets. They did very well because, investors thought that the Federal Reserve was going to cut interest rates. Investors thought that a recession was going to happen. And so, markets ran. They did very well. But by the time we came to July, things changed. The US economy was still very strong. There were no signs of a recession. The inflation numbers were starting to pick up. Bond yields in the US went up quite sharply, and that in turn caused the markets to pull back quite sharply. So if you look at this table, between August and October, the markets came down quite sharply. So the markets have been, the fortunes have been very mixed so far this year. First 7 months of this year has been good, but in the last 3 months, the markets are back to worrying about inflation and interest rates. If you look at how the markets have done year to date, still okay, right? Not too bad. But nevertheless, and if you look at November, this month, November, just in the last few days, the markets have suddenly come back to life again. So it has been hot, cold. It makes our job very difficult. How would I characterize the global outlook at this juncture? Now, if you look at this diagram over here, I think it's a tug of war between the headwinds and the tailwinds. And on the headwind side, you've got inflation, which I talked about a minute ago. You've got interest rates that are worrying investors. You have oil prices, which are actually quite high. Although they've come down, they're still high. You've got a very strong US dollar. A strong US dollar may not be very good for many Asian economies, at least in the short term. You've got problems in China. The Chinese economy is not doing well. And if China doesn't do well, we get affected as well. You've got concerns about a recession still at the back of investors' minds. You have concerns about corporate earnings. Investors are very optimistic about corporate earnings. But in the next 6 to 9 months, will that optimism change to a bit more pessimism? And finally, I think, geopolitics. You had the Ukraine war. Now you've got the problems in the Middle East. And the big one in 2024, the very big one, which I guess we can talk about later, is the US presidential elections. Who will win the elections? Will Donald Trump make a comeback and become president of the United States once again? And what happens if he does make a comeback and become president? What does it mean for the world, right? We can talk about it later. And on the other side, COVID was something that just happened in 2021, 2022. We started opening and everybody's out there traveling and spending and it's still going on. And the job market is relatively healthy, wages are still growing, and so people are able to spend. So it's very unusual. Central banks have pushed up interest rates a lot. They're trying to slow the economy down, but it's not happening in the way they want it to happen because I think consumer spending is very strong. Corporate spending is also relatively strong because we all just came out of COVID and we are fed up. We want to spend. Companies want to spend. They need to restock, rebuild the inventory. And that is making the job of central banks a bit difficult. But 2024, things may change. Some of that euphoria may start giving way to reality, and then the economy may slip into a recession. So is a US recession coming? I will talk about US because, US is a major driver of the world economy. And I think if you look at this chart, it tells you that despite the Federal Reserve pushing up interest rates by 5.5%, in March of last year, the federal fund rate was 0%. And they have pushed it up to 5.5%, right? And yet, look at the US economy. It's doing very, very well. The third quarter economic growth in the US was 4.9%. So, we're all scratching our head and wondering what is happening here. Interest rates have gone up so much, and yet the economy is doing very well. But it's doing well for now, but the question is, can it hold on? Will it slip into recession in 2024? Now, there's this rule called the Saham rule, okay? And this is a rule devised by an economist in the Federal Reserve. She worked in the Federal Reserve for 12 years. Her name is Claudia Saham. And this rule has proven to be quite accurate. So her rule says that if you pick the unemployment rate for the last 3 months, and you take the average for the last 3 months, and you compare it with the lowest unemployment rate in the last 12 months, now, if the difference is 0.5%, very good chance you have a recession in the US coming up. The latest unemployment rate in the US is 3.9%. The average in the last 3 months in the US is 3.85%. The lowest unemployment rate in the US in the last 12 months is 3.4%. So we're almost there, almost 0.5%. So if you apply her rule, it implies that a recession in the US is coming. And Saham rule has been quite accurate.
Vasu, be careful.
Yeah, that's right. Oops, I know. better stand in the middle. Okay, so if you look at this chart, it tells you, this is Saham Shuru. It tells you that for the US economy to slip into a recession, you need the unemployment rate to go up quite a bit. And it's starting to inch up. The US unemployment rate is starting to inch up, but not enough to cause worries. This is the chart that's taken off Bloomberg. It tells you the probability of recession based on consensus, what economists around the world think about the US economy. And you can see the probability of recession is seen as quite high, more than 50%. Right? This is what economists are predicting. This is based on a poll of several thousand economists around the world. Now, if you look at this chart from the New York Federal Reserve, again, you can see that this chart from the New York Federal Reserve is predicting a 56% probability of recession in the US in 2024. Now, this is a chart that a lot of us economists tend to use, and also investment strategies. We look at this thing called the yield curve, the US yield curve. And the US yield curve is now negative. And typically when the US yield curve goes negative, it implies a recession is coming. And right now the US yield curve is negative, which implies a recession is coming, right? And so this is another indicator that we tend to use. Now, this is an indicator that Jerome Powell, the current Federal Reserve Chairman, highlighted. And he talked about it 1 year ago. And people have been using this to also assess a recession. This is the gap between the current 3-month US Treasury yield versus what the yield will be 18 months down the road based on the futures market. So the current 3-month Treasury yield compared to what it will be 18 months down the road based on the futures market. And what it is showing now is a negative number. And what Jerome Powell said is that the Federal Reserve uses this. When the number turns negative, it means a recession is coming. So if you look at this chart, based on what Powell said, a recession is coming. Now, the other thing that's happening in the US is banks in the US are starting to tighten credit. Lending standards have tightened quite significantly, especially after the banking problems in the US in March this year. So the Federal Reserve conducts a survey among the banks, and the latest survey shows that banks have tightened. And if the banks are tightening, eventually it's a matter of time before the corporate sector and the individuals will start feeling the pain. Now, if you look at this chart, what it tells you is that if you look at money supply in the US, it has plunged. It's never happened before in history, but it's plunged. And so monetary conditions in general in the US are quite tight, and they could get tighter. History tells you that the Federal Reserve, most of the time, get it wrong. When they increase interest rates, they get it wrong, they send the economy into a recession. This is what it tells you. If you look all the way back to the 1950s, there's only been 5 times when the Federal Reserve's interest rate increases has not resulted in a recession. Other than that, whenever the Fed hikes rates, it results in a recession. Now, what has kept the US economy alive? Why is there no recession yet? Because of COVID, because of the pandemic, the US government undertook extraordinary fiscal policy. And that resulted in a lot of money going into the hands of US households. So at the peak, they had excess savings of $2.1 trillion. Now that has come down to now zero, almost zero. So US consumers had a lot of excess savings. They were spending money. They were keeping the economy alive. But that has now become zero. So going forward, the US economy may not be able to find support from what we call this pandemic savings. And so the economy could slow down. Now, earnings forecast is very optimistic. Analysts who are forecasting earnings, corporate earnings, they're very, very optimistic still. But, if a recession happens next year, what's going to happen is all these earnings forecasts will have to be revised down. And when that happens, the stock market will take a hit. So when Fifi asked me, what are your major concerns in 2024? I said inflation, recession. Because if a recession happens, somebody is going to prick a hole in this balloon or this bubble, and reality will bite, earnings will come down, and then the stock market will feel the pain. So if you look at history, whenever there's a recession in the US, the earnings takes a very bad hit. Even if it's a mild recession, earnings can actually fall quite sharply, right? And that results in a sell-off in the stock markets. which is what you see in the next chart. So whenever you have a recession in the US, the stock market does come off, right? So if you have a recession in 2024, the initial reaction may be negative. So will inflation continue to head lower? Well, it's come down. Inflation has come down. And tonight is a very important night in the US because tonight the US government will announce the October inflation numbers. Everybody's waiting and watching to see what the number is going to be, hoping the number will come down even further. If the number doesn't come down further, the markets could get frightened, spooked. But as it is right now, inflation is coming down, but not enough. Still not coming down enough, and so the Federal Reserve is going to keep monetary policy tight. Now, I'll skip this chart because it's a bit technical. Go to the next chart. Now, the other question is, will the US dollar continue to stay strong? The US dollar has done very well. And you can see from this chart over here, US dollar has done very well since June, July of this year. But I think going forward, the dollar may not do as, it may continue to do well for the next 6 to 9 months. But our view is that the Federal Reserve is going to cut interest rates sometime in 2024. When the Fed starts cutting rates, the dollar will start coming down. Okay, so the dollar has done very well, but we think that sometime in 2024, the dollar is going to start losing its shine. So valuations and liquidity, I want to talk about that. And if you look at the stock markets right now, they're not expensive. The markets have seen a correction. And in terms of price to earnings ratio, which is what we use to assess the stock market, it is not expensive at this juncture. Now, this chart is a chart which I showed to a lot of investors, and they find it quite fascinating. If you look at the US money market funds, money is sitting on the sidelines waiting to come back into the markets. Money seeking temporary abode in the US. Right now, you got $5.6 trillion in the US sitting on the sidelines. $5.6 trillion, record high. People are skeptical of the markets. People are very skeptical, they're very tired. For the last 1.5 years, they've been waiting for good news. There's no good news, and so they've been sitting on a lot of cash. The way I see it, this is positive because there's a lot of firepower on the sidelines waiting to come back into the markets. Now, if you look at the chart carefully, you'll see that back in 2007, during the global financial crisis, after Lehman Brothers collapse, you also saw a very big buildup of money market funds to $3.9 trillion. But when things started looking better, that money came back into the markets and caused a big rally in stocks and bonds. Now, you have a lot of money now sitting on the sidelines. They have not come back into the markets yet. They have not come back in. But if things start looking better in 2024, especially second half or first half 2025, once we go past a recession, this money will start looking for a home and it will come back into the markets again, right? So there's a lot of firepower sitting on the sidelines. Where do we see the Fed fund rate going? The markets are expecting the Fed fund rate to be cut by 75 basis points. In other words, 0.75% by the end of next year, right? This is what the markets think is going to happen. We think that the Fed will start cutting rates on June next year, and they will bring down interest rates by about 0.75%. And then in 2025, they'll bring down interest rates even more. Okay, so that's our view. And this is the important question. How have the markets reacted when the Fed finally wins the battle against inflation? As I said at the beginning, one of the big worry we have is inflation. One of the big worry that central banks have is inflation. One of the big worry that the US Federal Reserve has is inflation. But what happens when inflation is finally over? How will the markets react? I guess, 2-3 years ago, if I was here wearing a mask and telling you, don't worry, COVID is over, will be over soon, all of us will go back to life as per normal, don't worry. You'll probably laugh at me and say, this guy is mad, right? Because, we're all going through COVID, wearing masks, doing Zoom, and we couldn't see light at the end of the tunnel. We couldn't see the end of problems. It was hard to imagine this. But in the last 2 years, we have all been very worried about inflation. When will it ever come to an end? It will come to an end. But when it comes to an end, how will the stock markets react? So let's go back to history. Let's go back to the 1980s, when the US had very high inflation. In the 1980s, early 1980s, US inflation shot up to 14%, 14%. There was a Federal Reserve chairman called Paul Volcker. He said, very famous man. He pushed up interest rates in the US Federal Reserve Fed fund rate from 10% to 20%. Inflation 14%, he pushed it up from 10% to 20%. He did it over 2.5 years. The stock market came down, like it is what you've seen in the last 2.5 years. But finally, after 2.5 years, 3 years, inflation started coming down. Then they started cutting rates. And when they cut rates, what happened? You saw a huge rally in the market that saw the S&P 500 rally 224%. So in other words, we tell our clients that, yeah, the world has got a lot of uncertainty, lots of problems and all that, but don't forget, there's this $5.6 trillion in money market funds sitting on the sidelines, lots of money sitting on the sidelines, waiting to come back in. When inflation battle is finally over, that money will be ready to come back and we will see some good times. So in summary, I think the next 6 months, markets are going to be volatile. I mean, I think it's hard to predict the next 6 months. Too many things happening: Israel, Middle East, Ukraine, inflation, interest rates, fear of recession. It's all there. And I won't tell you that. I can tell you exactly where things are headed. You know, the next 6 months is going to be hot, cold, hot, cold, hot, cold. Some good news, some bad news. We'll be dancing, right, to the tune of the music. And I think the key thing to remember is the stock market is not expensive. The bond market is not very expensive also. So valuations are not expensive. And interest rates will start falling, we think, in 2024. And then the cut in rates will become more intense in 2025. And what will cause that to happen? Inflation will start coming down. Inflation come down, central banks have the conviction to cut rates, and that will fuel, I think, interest in investment markets once again, and we think that will fuel a rally. But between now and then, you will see a recession. And that recession is going to cause the markets to pull back. But after we go past a recession, once you go past the inflation, I think we start looking better and things start looking a lot better. So thank you very much. That's all I have to say. So the basic message is short term, we all have some uncertainty, but I think if you are taking a view of 12 to 18 months, I think there are some reasons to be optimistic. It's not all gloom and doom. Thank you.
Thank you, Vasu. Baik, kalau begitu kita akan lanjut dengan pembicara yang berikut. Profesor Iwan Jaya Azis akan menyampaikan pemaparannya. Silakan, Prof.
First of all, I would like to thank OCBC for inviting me, even though 30 plus hours flight. But, I think that this is an important event, especially given what's going on around the world. If you look at the title of my presentation, it's a bit unusual. And let me give you first the reasons why I picked this title. Several times I talk about this global economy, Asian economy, Indonesian economy, and so forth. I come to the conclusions that I think there is some missing link in terms of the discussion. And unfortunately, that missing link is, I personally think, is the most important one. And that is the human reaction, including policymakers, including business community, including public in general. So, for the lack of better term, let's call it the economic agents. A lot of reaction to what's going on in the world economy, the regional economy, it's really new and it's very unprecedented, implying that you cannot respond, you cannot react to this new unprecedented event using old way of reacting to things. So this is what I call inertia. And I'm worried if all the economic agents still doing the reactions like what they did in the last 20 years, things is not going to be improving. Because at the end of the day, sometimes we forget when we talk about banking, for example, we forget that who is behind the bankings? People, the bankers. We talk about monetary policy, we forgot who is behind the monetary policy, the people, the policymakers here. And when we talk about the people, this is the most complex human being. And that's the reasons why I think the focus now has to be on the behavior. And one of the things that worries me is the inertia. This is the reasons why I wish the message that I'm going to send today is really efforts to try to overcome that inertia. Things will be different. What is important now is to not really rely on whatever forecast that you made, your expert made. I'm sure your experts are good enough to come up with all kinds of models and give you scenarios. Think about alternative scenarios beside those scenarios. Let's call it plan B. So even though you have to make the decision, whether you're a company or a bank, you have to make the decisions, right? And the decision based on your expert analysis and so on. But think about plan B, because this is now very different. One easy way to describe how different it is now is that, complexity is always there. It's nothing new. Uncertainty is always there. It's nothing new. But, when you have complex system, at least when you close this tube, you know what's going to happen with the other tube. So it's predictable. Now, it's getting more difficult to predict. You think you close this tap, something is going to happen according to your prediction with the other hole. It's not. Worst of all is that we know we have multiple crises. I think Vasu mentioned about the war, about the COVID, about all kinds of things here. Now, that multiple crisis itself, it's different than just a number of crises. Why? Because the impact of that multiple crisis the total will be greater than the sum. They are all interrelated. This is the reasons why I'm worried if economic agents continue to react to the current situation using the old paradigm, using the old tools. So the best solution is think about plan B. Make a plan B, make a strategy B, which at this moment, maybe the probability is very low, but do not underestimate that low probability things can happen. And when that happens, if you don't have plan B, you're in trouble. Okay? So why don't I start with giving you a different way of looking at the global economy? I think that I have a chart here. Oh, how do I move this chart here? Okay. So this, to be honest, when we talk about global economy, it has to be one semester. I'm teaching one semester for this. So here I'm given only 20, 30 minutes. So this is the global economy in one page, basically. What we are experiencing now is not all of a sudden. It's not falling from the sky. We have the evolutions of what's going on. And let's start from the case before the GFC, before the global financial crisis. I think Vasu mentions about Paul Volcker. That was really the beginning of the trouble, the beginning of the low interest rate, because it was since Paul Volcker, this was in the mid-80s, interest rates started to go down in the US. And then many things happens. US in the recession in 2001, interest rate continued to go down. And then something happened. Katrina, I don't know if some of you remember, there was a major disaster in New Orleans. In Katrina, they pushed the interest rate down again. And of course, finally, the global financial crisis in 2008. They have to push down as low as possible. The interest rate in the US was 0.25%. And by that time, what is more important is how they reacted to this. This is what I come into the human reaction. What they reacted apparently have a huge repercussion to the rest of the world, including Indonesia. And I'm talking about global liquidity. What they did is unprecedented. You know, I'm a teacher. I couldn't find in any textbook what they did in 2009 to respond to the global financial crisis. And I'm talking about QE, quantitative easing. Not only that, there are 5 countries in the world adopted something that never exists in any textbook, negative interest rate. Can you imagine living in a negative interest rate? I think there are 5 countries: Sweden, Japan, EU. You know, there are 5 countries. Now I heard it's only 3, but at least there were 5 countries. If you are making business decision, based on what's happening with the global interest rate, I cannot imagine how difficult it is for you. In the meantime, there are a number of countries who started to raise the interest rate. So you have what they call the great divergence. On one hand, some countries adopted very low negative interest rate. On the other, some countries raised the interest rate. Can you imagine how they reacted to all this? Now, of course, the US will argue we had to do the QE because otherwise the entire financial sector collapsed. And you know what happened if the entire financial collapsed. The entire economy is collapsed because the US economy relies so much on the financial sector. What they didn't think about is the impact on the rest of the world. When they introduced QE, massive amount of capital flows out from the US, going to all over the world, especially emerging markets, including Indonesia. Before the GFC, the massive capital inflows came through the banking sector. If you look at the liability side of the balance sheet of many banks in emerging markets, all of a sudden exploded. A lot of them. The risk is pro-cyclicality, because when that money left, what happened in the asset side? That creates a headache already. And then came QE in 2009. You know what? Continue capital inflows to the emerging market. But this time, they're not using the door of bank. This time, since 2009, they came into emerging market through the capital market. Look what happened with the capital market. In Indonesia, look at the bonds market since 2009. Exploded. I remember because at that time I was helping the Asian Development Bank. The bonds market in Asia increased significantly. Now, you can wear 2 different spectacles. One spectacle is you're happy, you're proud that foreign investors trust you. But you can also wear another spectacle. This is dangerous. Why? Because of the risk of capital reversal. Whenever they left the country, the market will shatter. Think about the difference between bonds market in Indonesia and Malaysia. Both countries receive a huge amount of foreign capital. At one point in Indonesia bonds market, I'm talking about government bonds market, okay? At one time, it's almost half owned by the foreigners. This was after the GFC, okay? Now, the same thing in Malaysia, but here's the difference. The bonds market in Malaysia is quite thick. It's deep. But the bond markets in Indonesia is thin, it's shallow. So, if something happened, if those capital left the country, the entire market will be shattered. Early indication already there. 2013, I don't know how many of you still remember in this room. What happened in 2013? By now, they call it taper tantrum. There's a lot of capital left. And the bonds market in the region, in Asia in general, are also affected at that time. So, the thing is, how do we react to that? Unfortunately, so far, the way I see it, the reaction is like giving painkiller, not looking at the root of the cause of the problem. Let me give you one example. A country who responded to this trend that I was just telling you by looking at the root of the problem, and then they tried to prepare something. Korea. I remember vividly when there was a massive capital inflow coming to Korea, especially to the banking sector, the Korean government was worried, not happy. See, the thing is, when that happened, and then someone trying to remind the policymakers, be careful, they laugh at you and they think that you're a party pooper. Because everybody is having party. Why are you warning this? But the Korean was very smart. You know what they did? They introduced what is called levy. So if the amount of capital flows coming stay for X period, they tax you. If it is longer than X, the tax is lower. If it is longer than that, lower, and so on. So the whole idea is that to try to remove or to reduce the risk that I was talking earlier, the risk of capital outflow. Because if that happens, it will, shatter the market. So I'm just giving you what's going on in the world and how it affects the emerging market, including Asia. But the point that I'm trying to highlight here is that we have to think about how to respond to this phenomena, because if we use old style kind of a response, I'm afraid things is not going to get better. Now, let's go to Asia. As I said earlier, if you look at the helicopter view, you look at the global economy, of course, we are now in a sad state of global economy everywhere. But if you look at from above, which region in the whole world that are doing relatively well? Asia. Now, this is about Asian economy in one page. By the way, this number is not my telephone number, okay? 58. That is how much is the trade among Asian countries. So the easy way to think is this. Suppose the total trade in Asia is 100. 58% is trade among themselves. This is what they call the trade integration. 17, that's FDI, foreign direct investment. So if the total FDI in Asia is 100, 17% are among themselves. So Malaysian investing in Indonesia, Singaporean invested in Thailand and so forth. 17% of the total. That's the FDI integration in the region. 29, that's bonds market. So the integration in the bonds market in Asia is about 29%. What does it mean? That means majority of Asians are still relying on outside Asia, especially G2, European and American market. The next one is 21%. What's that? That's equity market. So if you look at the equity market in Asia, 21% among Asian countries. That means majority are with outside Asia. And last but not least is 38%. That's the banking. That's if you are looking at the loan and the liability on the side. The deposit and the loan side. It's about 38% among Asian countries. What's the conclusion? Number one is, as far as trade is concerned, Asian integration is really regional bias. And we know the story behind it, supply chain, production network, and so forth. But the financial side, Asians are still local bias and global bias, not regional bias. This is one of the reasons why leaders in Asia, including Indonesia, as I'm speaking now, are trying to think, trying to work out on how to increase that intra-Asian kind of financial interaction or financial integration. Example being the use of local currency. You know, I'm sure many of you knows, now I can use this kris in some of the ASEAN countries. So this is part of the efforts to increase those numbers, the financial sector. But what is more important, again, I'm coming back to reaction, human reaction. More important behind this story is that, how do we react to this? I don't know how many of you knows one of my favorite song is by the Eagles, and it says, this could be heaven or this could be hell. That's Hotel California song, right? The same thing with integration. Integrations can provide so many benefits. Risk sharing is number one. But at the same time, high integration also have risks. And the proof is, look what happened during the COVID. The supply chains has been disrupted. If I'm buying a certain type of Toyota, I forgot what's the name, you think the car will be shipped from Yokohama? No, coming from Thailand. Another type of car, if you buy it, trying to import, the car is not shipped from the original countries, but from other countries. Why? Because many countries, including Japan, decided to invest in other Asian countries. Why? Cost is lower.
Prof. Iwan, we have 3 more minutes.
5 minutes?
Okay, 3, 5. For you, 5.
All right. So my point here is that Asia integration is one of the reasons why, when you look at the helicopter view, Asia is doing relatively well compared to the other parts of the world. Okay? Now let me, 5 minutes, talk about Indonesia, and I will close by my concern, and hopefully this is going to be improving in the coming years. If we really genuinely believe that this is very unusual trend, and that is productivity. If you look at the source of growth in Indonesia, up to third quarter, so up to now actually, the major source of growth coming from services sector. Now, it can be good, it can be bad, depending on what services sector. Now, in services, unfortunately, it ranges from A to Z. Some of the services sectors are high productive sectors like telecommunication, IT, and so forth. Robotics, especially in Singapore, are very, strong on that. But in the case of Indonesia, the biggest services sector in terms of employment are trade. Now, there are 2 indications. I hope I'm wrong. Why trade? One indication is that gave an early sign it's not easy to produce. All kinds of challenges from labor, from regulation, from taxation, business climate, basically. Whereas if you do trade, easy. That's one indication. Another indication, and this worries me even more, and that is the biggest among the trade is retail trade. That means the small guys. Why it worries me? Because their productivity is very low. So what does it mean? That means the biggest contributor to the growth up to quarter 3, 2023 are the low productive sector. And as a result, no, I cannot move.
Here you go.
As a result, look at the bottom 2 charts there. The left one indicate I'm sorry to use this foreign language, ICOR, incremental capital output ratio. If those who are not economists, don't worry. Basically, it's an indication whether you are efficient or not using your inputs. The higher the ICOR, the less efficient you are. That's what's happening with the ICOR. On the right side, that is easier to understand. That's labor productivity growth. That's what happened. So, let me close by saying, given the uncertainty, including what Vanu mentioned earlier, I hope in the next few years, the focus will be on developing the sectors that has high productivity. Don't just develop sector. And this is the reasons why I'm worried if we keep talking only about growth. Growth is not something that is sustainable. Productivity is. So let me close by saying that all this, what I'm telling you, behind it is there is a human behavior. So I'm really hoping that we are all thinking more seriously about that. How do we react in this situation that is a lot of uncertainty, not only uncertainty in terms of the standard economic measure, inflation, interest rate and so forth, but uncertainty in terms of human reaction, in terms of human behavior, including how policymakers react. Thank you very much.
Thank you. Thank you, Professor. Prof. Iwan, if we are experiencing inertia, what is growth going to look like in 2024?
When we are talking about human reactions, it's not a short-term things, okay? The reaction itself is short-term, but the repercussions of your reactions, it can be longer-term. So I'm not too worried about the short-term. But by the way, there is one thing, there is a big giant in the room which both of us didn't talk about, climate change. And you think climate change is far distant, far remote. No, it's not. You think inflation has nothing to do with climate change. It does. El Nino, that caused the price of rice now in Indonesia is high. That's inflation. See, my point here is there are polycrisis. This is different from multiple crises. It's polycrisis. And that is the reasons why we have to think about medium term and long term. 2024, we survive. That's my answer.
Thank you.
But I'm more worried and I'm more concerned about let's try to make it good, make it better in the medium and the long run.
Thank you, Prof. Iwan. Okay then, ladies and gentlemen, we will be taking questions from the floor. Can we have the questions, please? So while we wait for the questions, wow, that is a statement. That's an article. Is that a question? Oke. Selamat sore Bapak Ibu, saya Agas dari Jawa Pos. Tadi Prof. Iwan menyatakan bahwa perekonomian di Asia terbilang aman, khususnya dibanding Eropa. Selain itu, Prof. juga menyebut bahwa perekonomian global tidak hanya uncertainty, apalagi sejumlah fenomena silih berganti. Oke, bagaimana dampak sentimen tersebut terhadap kinerja perbankan di Indonesia, mengingat ini tentu mempengaruhi dunia usaha yang kaitannya dengan kinerja intermediasi perbankan. Pemerintah seperti apa yang diharapkan agar pemerintahan seperti apa? Oh, maksudnya pemerintahan yang berkelanjutan atau bukan ya? Seperti apa yang diharapkan agar dunia usaha dan perekonomian Indonesia tumbuh lebih dari 5%? Prof, silakan.
Saya akan respon kecuali pertanyaan terakhir. I'm not going to touch any political dimension. I'm old enough to know the risk of doing that. Jadi begini, nomor satu kita melihatnya relatif ya. Jadi kalau Anda datang ke sebuah negara, kemungkinan besar masyarakat di negara tersebut akan komplain. Oh, keadaannya begini. But then when you step out from the country and then you look at the global situation, hey, apparently it's not that bad compared to the other countries. That's what I meant. Jadi secara relatif, sama sekali saya tidak mengatakan tidak ada masalah dengan Asia. Ada masalah, banyak masalah. Tapi relatif dibandingkan Latin Amerika, Afrika, dan Asia. Let me give you one statistic. Tahun 2023, data yang tadi disitir oleh pembicara pertama mengenai inflasi dan seterusnya. Anda tahu bahwa pertumbuhan ekonomi dunia selama 3 kuartal tahun ini 2023, total pertumbuhan ekonomi dunia 2/3 dari Asia. You tell me kalau the region is not doing well. Apakah itu an absolute term? Of course not. Banyak masalah. Saya bicara dengan teman-teman di Jakarta, banyak yang komplain juga. But look at this secara joke ya, ini tidak serius, tapi secara joke saya selalu mengatakan kepada mereka yang komplain, go to other countries, then you will appreciate what's going on in Indonesia. Jadi itu maksud saya, bukan artinya absolut keadaan di seluruh Asia itu baik. Tidak ada bagian di dunia sekarang yang keadaannya baik. Because the world is sick right now. Politically, economically, kita belum bicara mengenai geopolitical situation. Dulu masih ingat 10 tahun lalu, everybody talk about offshoring. Everybody now talking about not only onshoring, friendshoring. Jadi Anda membuat keputusan bisnis, merelokasi bisnis Anda bukan berdasarkan efisiensi lagi. Tapi apakah negara itu teman Anda? Artinya apa? Artinya you forgo, you sacrifice the efficiency. Mengapa dulu banyak perusahaan Amerika ke China? Because they want to make it more efficient, it's cheaper. Kalau mereka pindah, no matter what akan jelas lebih tidak efisien. And that worries me karena as he said correctly, US economy is the world largest economy.
Baik, Prof. Terima kasih. Ya, ada pertanyaan yang berikutnya juga dari audiens. Terima kasih tadi pertanyaan dari Jawa Pos ya. Nah, ini how long will the Fed's hawkish stance affect the Bank Indonesia's rate policy and also the Indonesia's economy in general? Ini yang jawab. Vasu, would you like to add that? I'm sure you're very fluent.
Okay, I can't completely comment on Indonesia.
Yes, please.
But how long will the Fed's hawkishness last? Our view is that probably a lot hinges on inflation. A lot hinges on inflation. As I said, tonight you have a CPI number coming out. Everybody's watching the number very carefully because you have one more Fed meeting at the end of this year, December, and one in January. These 2 meetings in December and January will kind of define Fed policy. If the Fed decides to do nothing in December and January, then confidence is going to grow that the Federal Reserve is largely done with increasing interest rates, right? So between now and the end of the year, you have a few reports, one or two inflation reports, 1 or 2 employment reports. Now, if inflation starts coming down further, then the Fed will probably not say, okay, we are going to turn dovish, we're going to cut rates. The Fed is not going to do that because inflation is now in the US running at about 3.7%. The Fed wants to see 2%. The Fed is not ready to send a signal to the market that we are done. Because if they do that, then inflation will go up again. Yeah. So they are going to give you the impression that they will stay hawkish until inflation comes down. So our best guess, and again, as Professor Iwan said, sometimes it's a guess, is that if US economy slows down sharply or significantly next year, in the first half or first 9 months of next year, if we see a mild recession in the US, inflation starts coming down closer towards the 3% handle. In our view, 3% is very important. If it goes below 3%, then I think the Fed is more ready to signal that they will turn less hawkish. So our view is that probably the Fed will turn less hawkish, more dovish in the first half of 2024. And then the Fed will probably start cutting rates sometime in the second half of 2024. The initial rate cuts will be modest, but the bigger rate cuts will take place in 2025. But let me just add a bit more, which is that what Professor Iwan said earlier about climate change and impact on inflation. It is true. Climate change is going to get worse. I mean, I think we can already experience it when I don't know how you feel in Indonesia, but in Singapore, at 7:30 in the morning, 8 o'clock in the morning, I can feel the heat burning my skin. You know, I used to be able to play football when I was a child, and I could play till 10 o'clock, 11 o'clock and feel nothing. Today, when I bring my 6-year-old daughter to play football at 7 in the morning, by 7:45, I'm burning. So climate change is the problem. It is going to result in higher prices. So I think the Fed knows that as well. So in the longer term, you don't expect inflation to come down and collapse. It will probably stay around a 3%, slightly below 3% level. So short answer is first half next year, if inflation comes down meaningfully, the Fed will start becoming less and less hawkish. Second half, the Fed sounds a bit more dovish. The Fed will start cutting rates. So it'll be a slow, steady progression. And what does it mean for, I guess, Asian central banks, Indonesian central bank? It'll be easier for them. I mean, they'll be able to, also slow down in terms of rate hikes. I think Bank Indonesia, the central bank actually surprised in October with the rate hike, 25 basis points, because they are worried about inflation, right? And also the Indonesian rupiah has been weak because the dollar has been strong. US dollar has been strong, and one of the reasons why I think the central bank increased interest rates also to defend the currency. But if the Fed turns less hawkish, then US dollar will start weakening. That will be good news for Asia, good news for Asian central banks, I believe, and good news for Asian financial assets, investment assets as well.
Okay, well, just a last question. Can you highlight 3 sectors which will have still a positive outlook for 2024, Vasu?
Okay, that is a more tricky question because if you just look at 2024 as what Professor Iwan said, I mean, we prefer to take a longer term view, but let me just talk about 2024. So 2024 is going to be, in our view, a year of 2 halves. First half will be very challenging, possibly recession. Second half, things will look a little bit better. By the end of the year, things will look even better, we think, right? Now, first half, sectors like healthcare, sectors like consumer staples will probably hold up better. Why do I say that? Because healthcare, consumer staples typically tend to be more defensive in nature. What do I mean by consumer staples? I think healthcare, you all know what is healthcare. But when you talk about consumer staples, we're talking about goods that people use day to day, whether the economy is up or down or whatever it is, you use it, right? And I'm not trying to promote any companies here, but I'm just giving you some examples of consumer staples. Procter & Gamble, Nestle, Coca-Cola, PepsiCo, companies like this that actually produce goods that are used by, Unilever, for example. These are things that people tend to consume no matter how the economy does. So first half, economy goes into recession. Some of these sectors like consumer staples and healthcare will do well. But second half, if we start emerging from a recession, late 2024, 2025, then you find the growth sectors will come back into play again. Banking sector, consumer discretionary, luxury products, those will come back into play again. So it's going to be a tale of 2 halves. But longer term, Fifi, I think climate change is one area you cannot ignore. So ESG is a sector that you have to look at. It's going to make a big impact in our lives. So, but still the investment universe is very small at this moment here in Asia, but it's going to grow and there are going to be opportunities. And I think technology, you cannot ignore the technology. It's very volatile, but I think technology is going to change our lives dramatically, especially AI, right? Artificial intelligence. It's going to change our lives dramatically. It is non-stop. The next 10, 20 years, I think we'll be living in a totally different world. And I think you need to have some exposure to these sectors. Not for 2024, but I think longer term.
Very well, Vasu. Thank you. Ibu Bapak, kami juga mohon kesediaannya, ini ada pesan surat cinta ya dari panitia ya untuk mengisi survei kepuasan acara ini karena tentunya perbaikan itu sangat penting untuk kita ya. Nah, Bapak Ibu, kami ingin mengucapkan terima kasih atas kebersamaannya mengikuti OCBC Experience. Mudah-mudahan perspektif yang diberikan oleh kedua narasumber yang luar biasa ini bisa menjadi bekal bagi kita untuk menavigasi berbagai dinamika 2024. Profesor Iwan Jaya Azis, terima kasih banyak. Vasu Menon, thank you very much. Saya Vivian Leda Yahya, selamat sore, sampai jumpa. Tepuk tangan yang meriah untuk para narasumber, Ibu Bapak.